When we look at the GMM map, when we look at the rupiah, when we look at the Indian rupee. I like a refreshing line. You say it's more to do with worsening of sentiment rather than a material change in the fundamentals. What, are we all just getting a little bit too overawed?
Look, I think that's our view, and thank you so much for having me this morning. When we look at EM and we look at what's happened this year, market down close to 8%, we really think that belies the underlying fundamentals at the corporate level. If we look at the 8% decline and break that down into some different components, what you actually see is a negative 12% decline in the multiple. You see roughly a 6% decline as it relates to EM equities on the FX side, but actually corporate fundamentals, if we think of dividends, if we think of earnings, have contributed 12% to that return. So when we kind of unpackage that, we say, well, yes, there's been a big shift in sentiment. Yes, people have been a little bit concerned around trade, but actually the underlying corporate dynamics are pretty good. We're seeing earnings growth for the first time in a number of years. Post 17, we saw big upgrades to expectations, and into 18, we're seeing some decent signs that that's continuing.
Yeah, I take your point, Luke, because in your research note as well, you talk about the fact that it is those corporate earnings that have historically been the driver of EM equity performance. But people keep talking about dollar strength. They keep talking about 10-year Treasury yields, quantitative tightening. So my question is it different this time?
Look, I think it's an interesting question about whether it's different this time. Dollar is always a challenge for EM equity returns because it's a translation issue. So we've seen a strong dollar environment. If you're an investor in EM equities, you're getting local currency return, and so that's a challenge. In terms of Fed, actually the interesting part is if you go over the last 30 years, what you'd find is EM equities have typically outperformed in a normalizing rate environment. Now, that's pretty much because what you would see is that the Fed starts to move rates higher as growth continues to improve. And the only times that EM has really struggled with Fed normalization is when you've had some idiosyncratic crisis. Right, Russia, LTCM, 1994 is the real obvious example there. And so some people have started to say, well, maybe trade and protectionism is that idiosyncratic crisis. We'd actually be of the view that it's a little bit overstated at this stage. It hasn't yet really fed through into growth and corporate earning dynamics to the magnitude that maybe the market's suggesting.
Good point.
Can I ask you, the one topic that we've been featuring on is oil. We've just had a conversation about it. But when we look at what the price of oil is for some of the emerging market countries, it's way worse than it was a number of years ago in terms of peso, in terms of rupee, in terms of Turkish lira, for example. And it really is a double punch, isn't it, for EM? You have oil marching higher, and people talking about $100 oil, and you have the Fed in motion. So how much of oil is part of this story that we're not talking about?
I think oil has a huge impact, but it's much more at the country level, Manus, from our perspective. I think EM as an aggregate asset class, when we think about equities, is not the oil-dependent asset class it maybe was 10 or 15 years ago. Right, I'll just give you some context there. In 2008, the commodity space in EM equities represented 40% of our index. Today, it's less than 15%. And so in that context, it's not driving the underlying market in the same way it might have done historically. It has that second derivative impact where, to your point, a lot of these underlying oil importing countries are struggling against rising oil and rising dollar. What we have to think about, and we're very much bottom-up active managers here, is we have to think about how that plays through into political agendas. And we've seen this a few times in the last 6 to 9 months. As oil prices risen, as dollar has strengthened, what you're seeing is governments actually force, in some cases, these state-owned oil operators to hold prices. And that can be a big challenge when you're an equity investor because, in effect, as the minority shareholder, you're suffering for that overall cause.
Yeah. As a bottom-up investor, what characteristics do you look for then in emerging market corporates that you want to invest in?
Sure. I mean, look, EM is a growth economy. We want to find growth, and there's some fantastic ways that we can isolate that within different parts of emerging markets. I think for us, however, as a minority shareholder in these businesses, it's absolutely crucial we focus in on the governance. That we understand what management is doing, we understand that they're aligned in their interest to what we want to see as a minority investor. And so in that sense, sometimes it's very, very challenging for us in EM where you've got heavy state ownership within the equity market, because oftentimes those are companies that are utilized more for the general benefit of the economy rather than for you as a minority shareholder. You're not seeing the returns and the cash flow generation. What you're seeing is more a way of trying to manage the overall economic transition.
Can we maybe just put this question to you? It's a new feature that we've launched today. So do you know what? Yourself and Stephen Macklow-Smith, you're the brave guinea pigs of Bloomberg. Here we go. It is the T-Live question. All of our viewers can join in. They can go to MLive and join in and ask a question. When does a rising oil price start to hit developed nation equities? You and I, we've just spoken about the EM consequence. Of course, our viewers can get in touch. They can ask the guest a question. If you have something on emerging markets you'd like to put to Goldman Sachs Asset Management, feel free. It's Luke's first day on the show. Why not pop him a question? I mean, the contagion aspect has probably got a negative feedback loop into EM, doesn't it? If we see contagion from oil and EM into developed markets, there's a negative feedback loop. Is that my risk?
Look, I think it's absolutely a risk. It's probably not something that we are overly concerned about at this stage. We think oil will likely be somewhat range bound. I know we're a little bit above that level now, but somewhere in the 60 to 80, maybe 60 to $90 range. And so it's not something we're particularly focused on as one of those existential risks to the cycle we've been in now for 10, 11 years. The one thing I'd say as well is obviously it's very different when we say developed markets, what we mean, because obviously the US oil price environment is now very different to what we see more globally. And so I think just considering that and how that flows through into our equity universe is quite important.